Good morning. Great to be with you. Again, we have come a long way since the shock of a 500 basis point interest rate factor completely destroyed any notion of underwriting or how you value commercial real estate in 2023. 24 was a little bit of a regrounding of those values, and 25 is now moving forward into a new cycle. And the Fed's move yesterday continued that process for this industry. Prices have adjusted, which is a really important reason why capital is coming back into commercial real estate. On a replacement cost and alternative asset basis, today's commercial real estate is far more compelling as an investment than it was even a year ago, especially with the Fed now becoming much more dovish. We're also seeing a big pullback in new construction starts, especially for multifamily housing, which had record production. And that drop in new supply will give the market some time to recover.
Let's talk office vacancy rates, right? Because there was all that doom talk. Nobody's ever going to go back to the office. Right. People are going back to the office, mainly because a lot of companies are saying if you don't, you can hit the road. Where are office vacancy rates now? Because I know across much of the country, they were at record highs recently.
Great question about a property type that has really suffered from the post-pandemic ripple effect that is now finally starting to recover. You're right. Overall vacancies are around 17.5% nationwide, down from north of 20% just a couple of years ago. In New York City, those vacancies are accelerating on their way down now. We're seeing a full percentage point drop in vacancies over last year, record absorption in Q4 and Q3 of last year, leading to a really strong 2025 for the market. What's interesting is that the daily attendance of office workers is now at 80% of pre-pandemic levels.
Lisa Mateo.
Up from 70% last year and 57% the year before.
I call that resilience.
Yes, it is.
Right?
But there's been a lot of pain in the process. A lot of properties have defaulted on their loans. And the bifurcation of older, obsolete buildings versus Class A, newer, more modern buildings is huge. Vacancies in the Class A newer product is, 11, 12% or so. And by comparison, you're looking at 25, 30, 35% vacancies in older, more obsolete properties, especially in urban markets. So it's a tale of two cities, and the reaction from the market to commercial real estate being the next shoe that falls because of office defaults was way over exaggerated. I've been on this program saying that for a couple of years now, and that's proved to be right. We're working our way through it.
Yeah.
How about the financing side of the commercial real estate business? Are the banks playing? Are they if I want to go develop something or redevelop something, and I want to put some capital into commercial real estate, where am I going to go? Am I going to go to my local bank? Where am I going?
Normally, the private investor, sub $10, $15 million price point, heavily relies on banks and credit unions, especially regional and local banks. In 2023, after the Silicon Valley banking crisis and first half of 24, banks were not lending. Underwriting was very tight. That has changed significantly this year. So the banks are much more active. The normal rotation of loans being paid off, maturing, is finally starting to recover. That opens room on their balance sheets for new loans. And that's another reason we're bullish for 2026 in terms of more transactions and refinancing.